outside of those two coins, Bitcoin and Ethereum, I literally would not be touching crypto right now with a 10-foot pole.
Jordan Belfort, aka the Wolf of Wall Street, is expecting Bitcoin and Ethereum to rise significantly despite the collapsed crypto exchange FTX's implosion. With the recent crypto market sell-offs, Belfort advises to stay away from the other 99% of cryptocurrency outside of Bitcoin and Ethereum and to strongly consider selling. He references the dot-com bubble, where 99% of the deals crashed and never came back, and says that after the recent collapse with FTX, the cryptocurrency market will fare the same. Let's check out the latest interview with Jordan Belfort as he talks about the scam with FTX and what effect this will have on Bitcoin and the crypto market. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
Number one, FTX was a scam, and there is no way to protect against a scam like that. But just because FTX itself was a scam, that doesn't mean that you can disregard Bitcoin completely and say it's worthless or going to zero. And the same thing goes for Ethereum. But my point is this: outside of those two coins, Bitcoin and Ethereum, I literally would not be touching crypto right now with a 10-foot pole. Now, if you already have other coins right now, you know, my opinion is the worst time to typically sell is just because everything is down at the bottom and you get panicked out to selling at the worst time possible. Anything outside of Bitcoin and Ethereum, I would take a pretty close look at it and consider maybe selling. And again, this has to be based on what you bought. Chances are most of these things are not going to ever come back. If you recall, the best example of this, the best sort of in memory, is the dot-com bubble, right? So you had this wild run up where anything.com, .com had a huge valuation, right? Then everything crashed in 2000, and over the next few years, the market was obliterated. That being said, the great companies ended up coming back stronger than ever. Companies like Amazon, just to name one, right? Went roaring back, hit new highs, and are now some of the biggest, most powerful companies in the world. However, 99% of the deals that were out there never came back because they never should have gone public in the first place. They were basically pieces of that were sold into the market amid all the hype and all the the promoting. So if you're involved in those sorts of tokens, well, honestly, if there's still some value left, I would look at them one by one and see if there's anything really there. But I personally would be getting out of all those. However, if you own Bitcoin right now or Ethereum, listen, you have to make your own decision. But personally, I haven't sold even one, and I'm buying more. That's not to say that I don't think it's going low, because I do think it's probably going to go a bit lower in the short term. So I'll keep buying it lightly on the way down. But I believe in the long term that if you hold these coins for 5 or 10 years, I believe those two have an excellent shot of being substantially higher than where they are today. You can't just say, I don't want to sell because it's down. I don't want to take the loss. That's the worst thing that you could ever do. The key to this decision is to go back to the time that you originally made the purchase and ask yourself, why did I buy it in the first place? And then see, are those reasons still there, or has something changed? If the reasons that you bought, let's say Bitcoin back when it was 40,000, if those reasons are still there because you think that over the next 5 or 10 years, that due to the scarcity, due to its utilization as a store of value, that you think that over time, as institutions step in, it's going to go much higher, well, guess what? It's a far better buy now at 16,000 than it was at 40,000. So you might consider buying more slowly. But remember, when you buy, you can't be buying for the next 3 months or 6 months. It doesn't work. These are ultra long term. I think it's a pretty good bet that right now down here, if you buy Bitcoin or Ethereum, chances are it will be substantially higher in 5 to 10 years now. Actually, a lot higher, I believe. In fact, if you asked me, I think I was asked when Bitcoin was 50,000, where did I think it was going? I said, it's going to 100,000, I think, or to 20,000. Like I said, no one knows where it's going over the short term. You don't know, so you have to play these things for the long term.
Belfort believes there's still the issue of contagions and unregulated companies exchanging funds between them. He says they all invest, borrow, and leverage from one another, calling it a house of cards and mirrors at the same time, where they pump up the values, issue their own tokens, and one person buys another.
What does this crypto crash remind you of? Well, it's a couple of things. There's a few different crashes all into one. What happens is when the market crashes, what do you see? Well, you start to see which companies were real and which ones weren't, right? At the end of the day, you have some of the largest companies in the world that emerged out of the disaster, right? One of the most obvious ones is Amazon, right? Just, out of the ashes comes one giant company. Now, there were many more besides Amazon, but the point is that when a crash happens, all it does, it shakes out all the, it sort of cleanses it. It separates the wheat from the chaff, right? So if you look at 1999 and you look at what's happening right now in the crypto world, what do you learn from that? What conclusion can you draw? Well, it's pretty obvious, right? That 99.9% of the deals that went public, so to speak, in the crypto market never should have been floated. There was no reason for them to exist. They were taken public to create fees. I'll give you one perfect example, right? You look at something like Bitcoin, right? Now, what is Bitcoin's use case? Well, Bitcoin, number one, is a store of value. You say, but wait a second, it hasn't been a very good store of value, Jordan. It's down by, 70% or 65%, right? How is that a store of value? What I'm talking about here is over the long term. The actual thesis behind Bitcoin is that over the long term, as it matures, at the end of the day, there's only 21 million coins, right? That creates a limit in supply. As the adoption curve keeps rising and keeps rising over the next 5, 10, 20 years, right? The price of Bitcoin being scarce will rise along with it. So there's a reason for Bitcoin to exist. It was the first coin out there that made any sense. There was actually experiments before this, but it was the first one that actually made any sense. The math behind it was very elegant. And over the last 11 or so years since it first, hit the market, right? It's developed a very, very widespread following around the world.
Jordan believes supply and demand concerns are secondary to the upcoming crypto regulations. This is so that any risk can be measured against the standards that are being created. According to Belfort, we now have the ability to price risk, which will have an effect no one anticipates. As long as crypto regulations are also engaged, the standards will provide enormous flexibility for institutions and pension funds. Since the launch of Ethereum and stablecoins, he believes that rules have a greater impact than anything else on the market. What do you think about Jordan Belfort's take on the crypto market? Comment down below. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.